20 million barrels of oil pass through a corridor just 33 kilometers wide. If it closes, markets do not dip, they seize. Energy prices spike within hours. Governments activate emergency reserves within days. And within weeks, the shock reaches households across Europe and North America. The Strait of Hormuz carries nearly 1/5 of the world's petroleum supply. Western governments do not treat it as a distant regional risk. They treat it as a structural vulnerability built into the global economy. The question is not whether the strait matters. The question is, what happens if control over it slips? To understand that fear, you start with geography. The Strait of Hormuz sits between Iran to the north and Oman and the United Arab Emirates to the south. It connects the Persian Gulf to the Gulf of Oman and the Arabian Sea. Every tanker leaving Saudi Arabia, Kuwait, Iraq, Qatar, the UAE, and parts of Iran must pass through this corridor. At its narrowest point, the strait is roughly 33 kilometers wide, but the actual shipping lanes are far narrower. Inbound tankers use one channel. Outbound tankers use another. Each is only a few kilometers across. This is not open ocean. It is compressed maritime traffic. According to the U.S. Energy Information Administration in 2023, approximately 20 million barrels of petroleum liquids per day transit the strait. That represents close to 20% of global consumption. It is not just crude oil. A significant share of global liquefied natural gas exports also pass through Hormuz, particularly from Qatar. The International Energy Agency has repeatedly identified the strait as the world's most important oil transit choke point. That concentration is efficient. It is also fragile. Now consider Europe. Europe is energy import dependent. Following the reduction of Russian gas supplies after 2022, European states increased LNG imports from global suppliers. Qatar became one of those suppliers. Qatari LNG travels through the Strait of Hormuz. If Hormuz closes, LNG cargoes do not leave the Gulf. European gas markets tighten, prices rise. The European Commission's Economic Outlook reports consistently identify energy prices as a primary driver of inflation. High gas prices raise electricity prices. Electricity prices raise industrial production costs. Industrial costs raise consumer prices. That is how a naval disruption in the Gulf becomes inflation in Berlin or Milan. Now add oil. European refineries are configured to process specific crude grades. Middle Eastern crude is part of that blend. If shipments are interrupted, refineries cannot instantly substitute supply. Alternative sources exist, but transport distances increase, insurance costs rise, and global competition for available barrels intensifies. Oil is globally priced. A disruption anywhere tightens markets everywhere. The United States may produce large volumes of domestic oil. According to the U.S. Energy Information Administration, U.S. crude production exceeded 12 million barrels per day in recent years. But domestic production does not isolate the United States from global pricing. Brent crude benchmarks influence global markets. If 20 million barrels per day are threatened, futures markets react immediately. Petrol prices in American cities reflect that reaction. Energy prices are politically sensitive. They influence consumer confidence. They influence electoral politics. They influence economic growth forecasts. So even energy exporting states fear Hormuz disruption. Now move beyond economics. The United States maintains the Fifth Fleet in Bahrain. The Fifth Fleet's mission includes ensuring freedom of navigation in the Persian Gulf. Its presence is not symbolic. It exists because Hormuz is a strategic liability. If the strait closes and the United States cannot reopen it quickly, global perception shifts. Allies question U.S. deterrence. Adversaries observe vulnerability. Credibility in one region affects posture in others. The U.S. Department of Defense's regional strategy documents consistently emphasize freedom of navigation as a core interest. Hormuz is the most concentrated test of that principle. Now examine military dynamics. Iran's northern coastline overlooks the strait. Iran has invested in asymmetric capabilities, fast attack craft, anti-ship missiles, naval mines, drones. These are not tools designed to defeat the U.S. Navy in open ocean battle. They are tools designed to disrupt. Naval mines are particularly effective in narrow waterways. Mine clearance operations take time. Time in Hormuz equals market panic. Even partial obstruction can slow tanker traffic. And markets react to slowdown almost as sharply as to closure. Now consider the psychological dimension. Energy markets are driven not only by supply, but by expectation. Rumors of instability have historically triggered price spikes. Commodity traders price and risk premiums. Insurance underwriters adjust coverage rates. According to maritime insurance reporting and U.S. government shipping advisories during past Gulf tensions, war risk premiums can rise sharply during periods of escalation. Those costs are passed to shippers. Shippers pass them to refiners. Refiners pass them to consumers. Fear compounds cost. Now widen the lens. China and India are major importers of Gulf oil. According to customs and energy data from their respective government sources, a significant share of their imports transit Hormuz. If the strait closes, China faces immediate supply risk. India faces similar exposure. This adds complexity. The strait becomes a multi-power concern. U.S. naval operations must consider global commercial shipping. European governments must consider Asian demand competition. The choke point becomes geopolitically crowded. Now examine reserves. The United States maintains a strategic petroleum reserve. European states hold emergency stocks under International Energy Agency coordination frameworks. Stock releases can stabilize markets temporarily. They buy time. But reserves are finite. They are not permanent substitutes for ongoing daily flows of 20 million barrels. A short disruption can be absorbed. A prolonged closure cannot. Now consider Gulf states themselves. Saudi Arabia, Kuwait, Iraq, Qatar, and the UAE depend heavily on hydrocarbon export revenues. If Hormuz closes, their export capacity collapses. Budget revenues decline sharply. Fiscal pressures mount. Domestic spending plans strain. Regional political stability becomes uncertain. So Gulf governments also fear closure. This fear drives defense procurement, naval investment, security partnerships with Western states. Hormuz stability is mutually dependent. Now layer currency implications. Oil is primarily traded in US dollars. Petrodollar flows reinforce dollar liquidity in global markets. If exports from the Gulf decline sharply, dollar-denominated trade volumes fluctuate. Exchange rates adjust. Energy importing economies experience currency pressure. Emerging markets with limited reserves face acute stress. The International Monetary Fund has repeatedly identified energy price shocks as drivers of macroeconomic instability. A Hormuz closure is not just a shipping issue. It is a financial stability risk. Now examine escalation pathways. Closure does not require invasion. A limited missile strike, a series of mine deployments, a tanker seizure, any of these can trigger insurance withdrawal. Commercial shipping firms are risk-sensitive. If insurers refuse coverage, ships do not sail. The strait can effectively close without formal declaration. That ambiguity is part of the fear. Now consider alliance dynamics. European naval forces occasionally coordinate with U.S. maritime security operations in the region. Freedom of navigation is not merely American rhetoric. It underpins European trade as well. If Hormuz instability becomes prolonged, NATO cohesion is tested. Collective responses must be calibrated. Escalation must be managed. Failure to respond decisively undermines credibility. Overreaction risks broader conflict. This balancing act generates strategic anxiety. Now consider the long-term shift. If Hormuz becomes persistently unstable, investment decisions change. Pipeline infrastructure expands where possible. Renewable energy investment accelerates. Strategic autonomy becomes policy priority. The European Union's energy security frameworks already emphasize diversification. Hormuz risk reinforces that direction. But infrastructure transitions take years. Markets cannot instantly rewire supply chains. Concentration risk remains embedded. Now return to the United States. Why fear? Because Hormuz represents concentrated leverage in adversarial geography. Because reopening a mined strait is not immediate. Because failure to secure it damages global standing. Because oil shocks destabilize domestic politics. Because markets react faster than military operations. Now return to Europe. Why fear? Because energy dependence magnifies vulnerability. Because inflation undermines social stability. Because industrial competitiveness erodes under high input costs. Because political systems strain under prolonged economic pressure. Because a narrow corridor in the Gulf can determine economic trajectories thousands of kilometers away. Now step back. The Strait of Hormuz is feared not because closure is inevitable. It is feared because closure is plausible. Because too much of the global energy system depends on uninterrupted transit. Because the corridor is narrow. Because the surrounding geography is militarized. Because the cost of miscalculation is global. Modern globalization prioritized efficiency. Efficiency reduces redundancy. Redundancy absorbs shock. Hormuz is efficient. It is not redundant. 20 million barrels per day passing through a few kilometers of water is not resilience. It is compression. And compression under tension creates fear. The United States fears loss of control. Europe fears economic shock. Energy markets fear volatility. Financial systems fear inflation. Gulf exporters fear revenue collapse. Importers fear scarcity. The strait is not merely a waterway, it is a pressure valve. And when pressure builds in a compressed system, release is rarely gentle. That is why Western governments monitor it constantly, not because conflict is guaranteed, but because vulnerability is structural. In a global system built on flow, choke points matter more than territory. Hormuz is the most concentrated energy choke point on Earth, and that is why the USA and Europe fear it, not emotionally, structurally. When 20 million barrels per day depend on 33 kilometers of water, stability is not assumed. It is managed, and management requires constant vigilance, because if that corridor ever stops flowing, the consequences will not stay in the Gulf. They will move through markets, currencies, alliances, and households. That is not alarmism, it is arithmetic. And arithmetic is why the Strait of Hormuz remains one of the most feared pieces of geography in modern geopolitics.